Thanks, everybody. My name is Patrick Zielbauer. I live in Dripping Springs, Texas, and I'm here to represent BlockFills. BlockFills is a Chicago-based liquidity provider in digital assets. We focus on spot trading. We do a ton of derivatives, crypto-backed lending. We have special ties to the mining community as well, having provided hundreds and hundreds of millions of dollars of financing backed by mining hardware. So we have deep ties to the institutional digital asset space. We have traditional roots. We are focused on bringing a very wide breadth of product to the institutional digital asset community. Those of you who might represent family offices or funds who are looking to find a way into this space and want to work with a company that has a very deep product breadth and depth, that is BlockFills. So we make markets on numerous exchanges. We trade. We offer access to some really interesting derivative products, and we are known for managing the volatility associated with a crypto-heavy balance sheet. So if you're interested in working or talking with me about these sorts of asset management solutions or trading solutions, certainly a conversation that I'd be willing to have. Excuse me. And we're grateful for the membership of TBC. Thanks for everybody for coming here, for Lee, for managing this whole process and putting it together. It's a fantastic community. This is our first event in Dallas. We'll be here at least 5 more months. And we sponsored a number of events in Austin as well. And we hope to see everybody as well at the summit later in the fall. It's going to be a fantastic event. So thanks everybody for listening, and look forward to speaking on the panel today. Appreciate it. Thank you.
Wanted to start tonight. We wanted to go through trading, have a conversation on trading, capital management, and each of the panelists today have a different way that they operate with the markets and how they assist institutions, individual traders, some family offices on managing the capital, how to minimize drawdowns, that sort of thing. So kind of go through each person. You guys want to introduce yourselves and just touch on how you do that.
I already went. So.
You already went. Yeah, you can't talk again. You're done for the evening. So you want to start, JJ?
Sure. My name is JJ. I'm one of the founders of Smart Money. Smart Money is a DeFi venture studio. So we both build and invest, and those two things kind of work together. So we built the first U.S. hedge fund built entirely out of smart contracts. So we operate a hedge fund. We don't have a bank account. We don't have a fund administrator. We don't have a custodian. Everything lives on chain, from the fund itself to the assets and the strategies. We then turn that into a protocol that will let anyone operate their own fund on chain with the benefits of automated fund administration. And we've built and operate some other things, and we'll be launching a small venture fund that will operate on the protocol as well. So we are probably the most DeFi, pure DeFi and DeFi native fund there is. And so we'll be coming from that perspective tonight.
Everyone, I'm Jack Zumwalt. I'm the Chief Executive Officer and the Co-Chief Investment Officer at Level 3 Capital. We're a digital asset hedge fund, very much so a hedge fund. We have a fund admin, auditor, and all that stuff. Not DeFi focus or creating smart contracts on that front, but we have a specialization in quantitative strategies. We also do blockchain yield strategies as well. We've been operating for about a year now. And prior to that, I was working at Goldman Sachs in technology risk. And prior to that, I was studying computer science.
So I'm Phil Stanley. I'm a registered investment advisor here in Fort Worth. I came to the space in 2014 as an intellectual curiosity, getting into Bitcoin in general, just more trying to figure out how to trade it. I was a trader growing up, and then worked for a family office, built out a small crypto desk there, family office, and then went in 2019 and started my own firm. And what we're doing essentially is offering traditional crypto custody services for rank and file people that want to get into the space. So we're offering crypto SMAs for individual clients. We can do traditional IRAs for crypto, Roth IRAs, LLCs, trusts, anything that really anyone would want. Outside of that, we also are pretty big in the Bitcoin mining, and we're one of the largest investors in some of the natural gas Bitcoin mining here in Texas for Giga Energy. So,
Yeah. And I think one of the things that what's interesting with each person, Patrick, you do some interesting derivatives trading. You help people set up, for the miners, generate revenue. Phil, you help people, on the emotional control side a lot when you're trading and capital allocation. On an RA, you're just making sure that clients don't make bad decisions with
and
capital.
make sure that's regulatory compliant.
Regulatory compliant. but as far as when you're helping people not make bad decisions when the market's gone down and they want to sell it, cash out of everything, and
Right.
you're going for the long term.
Yeah, absolutely.
And then Jack, you're active management,
Yes,
making
yes,
those
that's
decisions and going through that.
correct.
So
Yeah, active management, systematic, automated trading, all of that.
and how do you build those models? How do you?
Yeah, so when you're talking about
How do you approach
building
it?
quant models, it's very mathematical, logical, right? I come from a very quantitative and functional background, and so you have to look at the market as almost like a logic puzzle that you're trying to figure out, right? You're trying to figure out how it behaves and then exploit that in some way in order to minimize drawdowns. Ideally cut volatility in half, get outsized returns over time, and these are things that we're pushing out in Level 3 Capital. And this is the reason you attract family offices, endowments, pension funds, and stuff like that. And through these quantitative models, they work best in an environment like crypto assets, primarily because the inefficiencies that exist, because it's a very youthful space. A lot of the alpha in the stock market, in the bond market, commodities, whatever it may be, is chewed away. Most of the arbitrage opportunities are gone, right? But if you're trend following, doing arbitrage, high frequency trading in crypto, there is so much alpha to be made over the market, and the alpha in the market is greater than the performance over time of assets like Bitcoin and Ethereum, which are greater than assets in the stock market or in the bond market or commodities. So you're dealing with a very volatile asset, and you're taking it, getting outsized returns, cutting volatility in half, and also minimizing drawdowns. One thing that we say to investors is our goal is to participate in roughly 80 to 90% of the bull market. But then, in a bear market, we only want to occur roughly 30% of the drawdown, right? And by doing so, you get these statistics that I described. And this is what is considered an attractive vehicle in the crypto space.
And when you were sorry, I just lost my train of thought there. So you're looking at, you're doing backdating on the trading. You're looking backdating stuff. You're also looking at coins trading at different prices on different exchanges.
Of
And these
course.
are all things that the average trader, the average retail trader is not taking advantage of.
Exactly. So like when a retail investor comes to me and they're like, or a retail trader maybe, and they come to me and they're like, okay, what do I do? Right. Well, first of all, you need to spend 24/7 of your time doing this, right? This is what's necessary to create something that's actually, manageable. What we started with was, basic Python scripts and stuff like that. But we, branched it out into an entire automated trading platform. We ingest all of our data, run our trading algorithms, and we execute automatically with these exchanges without, touching it at all. And then we apply our quantitative models to this that are built out over time based on assessing the market and its behavior based on our mathematical backgrounds. And then you eventually have something that can't be competed with by a retail trader, right? And that's an issue for some people. But this is why these sophisticated vehicles are very important.
And when for each one of you, how JJ, how do you approach, how would you compare the DeFi space in relation on the trading side? How much is trading? How much is?
Yeah, I think trading takes on a very different definition in DeFi. High frequency trading, typically involves the things you can take advantage of that have to do with the way order books work and the way liquidity works. When an order book is necessary and depth of liquidity is a key part of the investment strategy, the trading strategy. So one of the most revolutionary aspects of DeFi is the concept of an automated market maker, which is the technology that underlies the decentralized exchanges. And without getting too far in the weeds, what it means is that things that didn't used to be liquid because there wasn't enough depth in the order book are liquid and infinitely liquid, even though there may be a lot of slippage, you may not like the price, but things become liquid. And so that changes investment strategies to open up this whole new swath of risk taking and things that you can play with that you previously couldn't because of liquidity concerns. So we don't do anything that involves we don't have any mathematical models involved in what we do. It's the way we sort of look at it as essentially a liquid form of venture capital, where a lot of these, especially in DeFi, these are early stage technology projects that just happen to have a liquid component to it. And so there is a tremendous amount of risk associated with these things, not just the success of the project or the economics of the project, but the smart contract risk associated with them. And so a lot of those kind of aspects are not things that you can plan around an equation, right? And the other part of that is what makes DeFi unique is because of smart contracts and because you've made money programmable. One of the key aspects of DeFi is the concept of rehypothecation. Dan Elitzer wrote a blog post a couple of years ago. It was called Superfluid Collateral, and it was the idea, hydroponic superfluid collateral. And the idea was that DeFi turned money into a version of, I'm not much of a gardener or someone who grows things, but there are those farms that kind of use water trickling down to multiple levels of the plant they're growing, and that is what DeFi enables with money. That you can basically be taking $1 and be putting it to work in 3 different ways at once. And so that makes DeFi kind of like this money puzzle where your strategy involves not just what is this underlying asset, but how does holding that underlying asset then unlock these next level opportunities for yield. So every asset, every position that we're in involves kind of a multi-layered strategy that goes well beyond, what is this asset and what is the market cap of it. That's a fundamental aspect of how we construct strategies, but without considering those second and third and fourth layer yield opportunities, any strategy we put together is incomplete. So none of that can be handled by, equations, so to speak.
So I think on the DeFi side, you're talking about the AMM, and it all comes back down to the liquidity pool, and that's what BlockFills, Patrick, that's what you guys are providing. You're getting clients together, they're putting together the capital, the Bitcoin, and then you're offering that to.
Right. I mean, basically, the concept of a centralized exchange is kind of a weird concept in our world because the market, even with the presence of so many centralized exchanges, the market is extremely fragmented. So you've got, 20, 30, 40, 50 exchanges all showing the price of the same asset at a different price. So you have very smart people who are finding ways to exploit those differences in price algorithmically. And that's how a fragmented market can be made more efficient over time. It's by those inefficiencies becoming exploited. At BlockFills, we are admittedly a little bit less involved in the DeFi space. BlockFills has never been necessarily the first mover. We do have a little bit more of a traditional background, so that's probably saved us a few times because there have been a lot of well-known disasters in the DeFi world, and we do act sort of as the stewards of our clients' funds. So we're very conscious of that. But the idea with our company is from a liquidity standpoint, is that if somebody wants to come in on a Friday afternoon and buy $30 million worth of Bitcoin, you cannot place a trade like that on an exchange. You're going to destroy the order book. You're going to get filled all over the place. They're going to charge you, 20 to 50 basis points for the pleasure of ripping your eyes out on the fill. BlockFills provides a very, very deep aggregated ecosystem to facilitate the kind of trading associated with major institutions. So that's typically where we face. The concept of AMMs and DeFi. I mean, I went down this rabbit hole about 6 months before I joined BlockFills. How many people in here have traded on Uniswap? How many people have like a MetaMask wallet? So the concepts of DeFi are not lost largely on this crowd, but I mean, it is an area that is, the community is largely, not educated. It's not that easy to get involved in. There are groups that are making it a lot simpler, but we at BlockFills are not necessarily participating in AMMs. We want to get into that space a little bit, but it's going to take some time before the types of clients we deal with are going to be willing to, expose themselves to things like smart contract risk.
I was meaning more for Jack, the principle of liquidity pools, to being able to tap into that. If you have a very thin liquidity pool, you need somebody like BlockFills to be able to not spike that price.
Right.
You click that and, small order will throw you way out of whack and you get filled 4 or 5% out of where you thought you'd get filled. So, anyway. So, Phil, you take a bit more active process when you're doing the Bitcoin, when you're in the natural gas space, Bitcoin mining. How do you approach that?
Yeah, I would say we're kind of hedge fund light. We are an RIA, but if we find an attractive opportunity outside of just the traditional stock, bond, and mutual fund space, we will go out and create a SPV, like a special purpose vehicle, specific to that one investment. And then we'll aggregate client capital through subscription agreement and operating agreement, and we'll go out and deploy that capital after we've done enough research. And then, like here recently with Giga Energy, we're the largest shareholder of that Bitcoin mining operation. We had a goal to go in and create 4 data centers between September to January 1. And with some additional liquidity that we provided, we were able to go in and we got 8 data centers put online in the same amount of time. And investors are extremely happy. So we try to straddle a little bit of the traditional kind of private equity space where we're deploying capital into non-traditional assets and doing it in a way that's pretty agreeable to clients that they wouldn't normally have access to.
Gotcha. And what do you, for each one of you, how are you each looking at risk? I know, Patrick, you mentioned within the DeFi space that there's been some challenges out there. JJ, how do you approach that risk and accounting for that, hedge against it?
So the bulk of the risk in DeFi is smart contract risk.
Which is why everybody needs to talk to Michael, if you want to understand. There he is.
I have been victimized by smart contract hacks personally and professionally, and am still pretty comfortable with the risks. I've been victimized by 5-figure losses multiple times, again, both personally and professionally, and yet the gains possible in DeFi have made all that up and more. So it's kind of part of the game. As far as what we do on the professional side, when we are, obviously a fiduciary for other people's capital, we look at that as part of our job, is managing that smart contract risk. So part of that is understanding smart contract risk and understanding, what mechanisms are safe. The reality is you can never say anything in DeFi with smart contracts are 100% safe. However, things do kind of, the Lindy test kind of applies. There are certain contract mechanisms that have had, hundreds of billions of dollars pass through them and have not been hacked. And so while I can't say they'll 100% never be hacked, in all likelihood, they're pretty safe. And then, I understand smart contract mechanisms well enough to understand what I'm doing in terms of like, is this riskier than the majority of transactions? And so, I am just in looking at a mechanism, I can generally assess a level of smart contract risk, and we tend to only put our LPs' money in mechanisms that are pretty tried and true and are pretty safe. I mean, we reserve the right to, if there is, as we say in the industry, something worth aping into, we will certainly do that. but generally we just tend to stay in tried and true smart contract mechanisms. And then, our fund is set up, we have 2 on the investment side and 2 on the engineering side. So we can evaluate the code of any smart contract that, we might have questions about at a very deep code level and have tremendous expertise in that area. And, we believe that that is a skill set that's required for a DeFi hedge fund. If you're a Wall Street hedge fund and you're in, some particular, you've got some particular investment strategy, then you need people who can assess all the risks associated with that particular strategy. And when it comes to DeFi, being able to understand smart contract risk is germane to being able to operate. So those who are, investing in complicated smart contracts without that capability in-house are to some degree guessing. And so we do manage that risk. Some of it is unknowable, but we are set up well to manage that risk and have loose policies about what kinds of smart contracts we'll interact with.
And I just have a comment on that too. One of the things, just to reiterate, one of the things that I do not have a development background whatsoever, so I'm going to put that right out there. But I actually have learned the most about, this smart contract risk by reading Twitter threads of like it's like the autopsy of what happened.
Yep.
I mean, it's an unbelievable amount of information that's available out there. And if someone like me can garner something positive out of something like that, everybody should try to do that. I mean, and I think it is true that when you get into that world, you need more than traders. You need more than just you need someone who can actually look at, post-mortem history of these exploits and figure out how to plug the hole the next time around. That has been an area that's been really illuminating for me, just being a user of these protocols, because I've gotten rugged and smoked on all of them as well. Personally,
I think we all have. I think you're in the space for any amount of time you can have rugged somewhere.
It's almost like a rite of passage. I mean, that's how I got. One of the reasons I got really involved. So yeah, I think that's really fascinating stuff.
The other side of that is white hat hacking is a very key part of the ecosystem. The number of people, if I had to guess, there are probably somewhere between 100 and 200 people in the world who are good enough to really be white hat hackers. One of the other interesting things about smart contract hacks and rugs, as we call them, is that frequently people have to give the money back. And sometimes they might steal $30 million and the protocol will say, listen, we'll let you keep $1 million if you give the other 29 million back. And that actually happens quite a bit because remember, all of these, someone might be able to steal that $30 million, but they can't disappear with it. Everyone can see that it went from this account to this account. And so everyone can see that $30 million. It's not in the address it was before, but they can see exactly where it is, and there are limited ways to try and hide that. So there are also social aspects to smart contract risk, but there are only so many things you can do with the money once you've stolen it. And so, but those white hat hackers are performing a very valuable service to the industry in that they are forcing the industry to level up and take smart contract security extraordinarily seriously. And that's important for the growth of this ecosystem to make sure that as retail folks do start getting involved in DeFi and have their capital in DeFi protocols, that they are battle tested and that they have been put through the ringer, and that these 100 to 200 extraordinarily smart engineers who know not just the ins and outs of Solidity and smart contract code, but exactly how each one of these protocols works, because generally these smart contract hacks involve one transaction that may or may not interact with 7 or 8 different protocols at once.
Jack, how do you guys look at risk?
Yeah, for us, it's partly the same, but not so much on the smart contract and counterparty and custodian risk. For us, it's mostly on the market risk, right? You described people who focus on investment strategy, they have to deal with the market risk, right? That's exactly what we do, right? And in quant trading, you can create these models, you can create this system that works, right? But you, at the end of the day, choose the environment that it's operating in, right? So are you trading Bitcoin, Ethereum, or are you trading, meme coins, very low market value, market capitalization assets, right? Are you trading things that are worth $1 million or, $500 billion, right? One thing I've noticed over the years is that, a lot of crypto assets do succumb to survivorship bias to some degree. What I mean by that is that these assets, while, they might be in the top 10 market capitalization assets in the 2017 bull run, it doesn't mean that they will be in the 2021 bull run, right? And as a result, the assets that you choose, if you are a long-only fund, for instance, might limit your potential in performance, and it also might increase your downside risk, right? So when I see risk, I see the downside risk. I see the risk in your portfolio absolutely collapsing, right? And although there is that degree of smart contract stuff that we do on the side with stablecoin lending and everything like that, most of it is in the assets that we select, the environments that we create to trade in themselves, and then it comes down to the quant models. Are we evaluating risk there? And a lot of it is handled there.
Gotcha. So JJ, you're looking at it from the contract side of it. And then Jack, you're looking at it from your model side, where how deep in how much liquidity you need to be able to get into something, and then whether you're going long or short.
Yeah, and also just what assets you're trading, right? Ideally, you want to like you said, JJ, you want to stick with the tried and tested assets, the ones that have been through bull markets and bear markets.
So Doge, you're saying
survived.
Doge.
Right?
I have to do that for Ryan because he loves Doge. So
I mean, it has survived. So
you survived.
So far.
And then Phil, how are you guys looking at risk?
Yeah, ours is pretty traditional. I mean, we hold custody at Gemini for our RIA clients. We have two-factor authentication and then cold storage for all the client assets. So there's really no effective way that I'm aware of at this point. If a client has, especially if it's in an IRA, there's really no effective way for those Bitcoin or any of the other assets within that IRA to be moved due to the way that they're stored in cold storage through Gemini. As far as risk goes, I mean, I feel like my background at the family office was essentially to look at all kinds of different asymmetric investment protocols, and the families would come and they'd say, Phil, we've got $20 million that we want to invest in XYZ assets this year. Here are the ones that we want to go after. You go pick, you tell us what we should and shouldn't invest in and why. And if we should, how much? And if we shouldn't, can you please call the other person and tell them politely, no, thank you.
Gotcha.
So that when I evaluate private equity investments outside of the crypto space, it's always coming from that background.
So it's on your knowledge base and then custody,
Right.
who you're trusting with the keys of your
Absolutely.
coins, the Winklevoss twins or Winklevi or
Yeah.
however they say
the
it.
Winklevi.
The Winklevi are not running off anywhere.
Yeah, absolutely.
And then how are you guys looking at risk? I mean, you guys have risk when when people put capital with you guys, and
So-
you're doing loans and
We do operate in a lot of these different areas. I mean, we are mainly an agency business. So, for example, if an institution comes in and makes that big trade with us, we are algorithmically getting that trade off our balance sheet with another counterparty in milliseconds, right? So we are not a principal risk firm, and that we are just trying to swallow up and what they call B-book, just take the other side of every trade that a client does and just hope that they lose. That's the way that a lot of market making businesses work. It's not how BlockFills works. So our risk is, the way we look at risk is mainly counterparty risk. So it's probably a little bit more traditional, like Bill here, about how we who we deal with, what do we use for security infrastructure. BlockFills is very tied in with a very well-known security infrastructure provider called Fireblocks that some of you may have heard of. Copper is another one that we work with. So we work with top-tier technology, onshore banking, and we're primarily focused on minimizing counterparty risk. And because our business is so tech-driven, we are heavily focused on minimizing execution risk. But we are not a big principal risk type firm in that we're not taking a lot of principal risk ourselves. We take some in some cases, but the majority of the trades that come into our ecosystem are laid off immediately. So we're more of a transaction business, and that aligns really well with our clients because they want to know that we're not just trying to take the other side of the trade and give them the worst price or something like that, which is unfortunately how a lot of this, business is conducted, even in traditional markets.
Well, I mean, you see it on Twitter now with people talking about market makers moving the markets to, try and get, they'll go ahead and they're doing your business, but then they've got the trading arm that's also bumping the price to liquidate through, and they know the order book. And
do you think that Binance Global is not trading in their own ecosystem? I mean, come on. So we are. I mean, there is, the idea of market making in your own ecosystem is kind of a weird idea. I mean, that would never really fly in, most traditional markets. But this is not traditional. This is crypto. So
you have FTX and you have Alameda Research. There's nothing. Yeah.
I mean, it's just it's a frontier industry.
Right.
And so, yes, I mean, we don't make markets in our own ecosystem because there's argument to be made that misaligns your interest with your users.
Now, when we look at everything, when we look at this, we started off with how you make money. We go through the risk that you assess, and there's varying degrees of risk. And I think as JJ pointed out, he may take on higher risk, but the reward, it's always a risk reward ratio that you're looking at, and then where you're operating in that that risk reward on that risk reward curve, and some are more comfortable further out the spectrum, and then they get much higher reward, and some are much closer, feel you're much closer and on that. So what do you guys see as when people are trading, the difference between trading and investing? What's underappreciated by the average person in the crypto space when they're entering in and thinking, hey, I'm getting into Bitcoin, I'm getting into Ethereum, Dogecoin, right? And whether that's a short-term, long-term, what do you think how people should look at that? No, good. I'll start with
sure.
you. Patrick's got 20 years of this, and he's all sorts of markets, and just the knowledge base is fantastic for it. So,
thank you. I think the answer to this question depends largely on who your clients are. There's a lot of Bitcoin miners, in this space and in this group in TBC. If we're talking to a miner who's entering the business from traditional oil and gas background, they look at Bitcoin as another asset that has a forward curve that can be hedged, and they don't look at it as Bitcoin to the moon. They look at it as, we know what we're supposed to make, we know what our operational risk is if Bitcoin falls under a certain price. So we want to account for the risks using derivatives products, just like we do when we're drilling for crude, or when a gold mine is mining gold. It's very, very similar to any other commodity. So because we deal with a lot of groups who care deeply about downside risk, we care very deeply about derivatives, because a well-established derivatives market is a sign that a market is maturing. And so we are very, very active in that space. So we are typically looking for asymmetrical opportunities to collect premium and buy near the money protection. It's a very common strategy. It's called a collar. It's an option collar. Google it if you've never heard of it. This is not reinventing the wheel. It's something you could do really on any number of commodities. So we are focused mainly on helping institutions, whether it's a family office or a hedge fund or a miner, hedge their downside risk, not necessarily take a flyer and try to knock it out of the park. So our approach is just a little bit more traditional, maybe a little bit more defensively postured, because that's the typical client we serve.
Can you describe a collar for anybody that doesn't?
Yeah, an option collar is like if you sell a call and you take the proceeds and you buy a put. So that's called a zero. If you do that properly, at least as we would say, that's called a zero cost collar. You would sell a call above the market when the market is going up. The call price is very high. You sell the call, and then you take the proceeds of that sale and you buy a put as close to the market as you can. And so if you can do that for what's called even money, which means that you actually haven't spent anything. You're still long up until your short call, but you have protection under your put, which is much closer to where the market is. So I know we can go down the rabbit hole quickly on that. But it's not that complicated of a strategy. And in crypto, it's uniquely poised because there's so much implied volatility on calls, because everybody's just waiting for this thing to rocket up. So that is why the calls are so expensive and so juicy, as they would say, where you can sell them for a lot of money. And there were some examples in the last 2 years. I mean, I don't know how many people look at the price of Ethereum, but just as an example, you could at one point in recent history sell an $8,000 ETH call and buy a $1,700 put for no money. That means you get to stay long all the way up to ETH 8,000. We haven't even gotten close. That's how juiced up that market was. How do you not at least consider a trade like that if you have a big ETH portfolio? I mean, you have to at least think about it. So that's the way we generally approach it. It's not about, trying to hit a home run. It's about trying to use the conditions that exist to protect the downside. So when it comes, you look like the smartest person in the room, ultimately.
What was the market price at the time?
I think that was when we were close to 4,000.
40,
Yeah,
it was
4,000, 44. We were up near 44. Same thing with Bitcoin. Like you could sell a $120,000 call and buy a $48,000 put for even money. I mean, if you're long BTC and you intend to stay long, you have to consider something like that. So we look at those opportunities opportunistically. When they seem right.
And some of the decentralized options that were out there, if you could get them for those pools, were even crazier. So, appreciate that. So, and then any of y'all have any input on that?
Sure, can hop in on that. So the way I see it is primarily from the institutional side of things, right? So, when you're raising a large amount of capital from institutions who want to push, tens of millions of dollars, hundreds of millions of dollars, what are they thinking when it comes to the space? Most of these institutions are still trying to grasp onto the idea that, a crypto asset is something that I should invest in. I feel like they're coming around quite a bit. They're finally viewing Bitcoin as something that they cannot avoid. It will be around for a while now, and it also provides uncorrelated returns relative to other asset classes. So now they're starting to view it as almost, I think a Galaxy Digital CEO put it pretty well recently. It's like the fifth asset class that exists. So you have stocks, bond, commodities, and infrastructure, and then you have crypto, right? And these uncorrelations dictate what an asset is. And so they say, okay, I want this to be part of my portfolio, right? But how do I want to do it? That's the next step. I find that a lot of these, multi-billion-dollar fund of funds, family offices, even pension funds actually, they'll just buy spot Bitcoin, right? They won't participate in derivatives, they won't do anything like that, but they'll buy a very small portion of it, and it's typically 0.5% of their portfolio, 1%. And then they look at how that affects their portfolio over time, and there's a lot of data that suggests that it will increase returns and not increase risk too much. But another way of looking at this is, sophisticated investment vehicles like a hedge fund, right? Some of them, are in the mode of wealth generation as opposed to wealth preservation. A multi-billion-dollar vehicle is going to look for that preservation over time, but the smaller family offices are typically more risk-prone and more willing to go into these crypto asset investments, and so they'll invest in an active management investor like ourselves. In order to do all the things I described before, get outsized returns, mitigate downside risk, all these different things.
So maybe your more established funds are looking at it from a currency default standpoint, a bit of insurance, smaller portion of the portfolio, and then the family offices looking at are more likely to look at it as wind moon. Not in those words, but
exactly. And I think that'll change over time. I was speaking to like a very large fund of funds. They're managing like $7-8 billion right now. And, recently they had done their first initial purchases of passive investment vehicles in like Bitcoin, right? And they had put up maybe $200 million into it. And they have not pursued active management vehicles yet, but that's definitely in their timeline, that's for sure. They do all this in the equities markets and in the commodities markets, but they just haven't gotten to it yet. But they do intend to get there. So it's just a thing that takes time.
So the funds are, one of the things when you talk to family offices, it sounds like they're a lot more methodical and, they're slower moving, but they're a lot more methodical and thought out on how they're going to enter the space. Whereas maybe the retail trader is much more emotional entering the space. Maybe they catch one trade and then they're suddenly all in and their portfolio is allocated.
Yeah, their risk profile is definitely different. That's for sure.
Right. And over trade, I mean, I I haven't looked at the statistics for traders in crypto versus traders in the stock market, but I'm sure it's much worse. Traders that are entering in and out of positions are, doing far worse than investing for the longer term and the solid projects that you guys are all talking about. Is that sounds fair? Would anybody disagree with that?
I would actually segment it. I think there are more segments to the market than that. So first, as we're all saying, institutions and folks that are in TradFi in various ways are all in some way coming around to the tough for them conclusion that this is a new asset class, if you want to call it an asset class. This isn't going away. And oh, by the way, if I want to have competitive returns, I better figure out how I am getting involved. And so there's the first step of that, which is actually where many of these institutional folks are, which is, okay, I do need I do need some exposure to this. And so for many of them, that just like the big leap is they have a custodian account at Coinbase custody or some institutional custodian, and that custodian holds Bitcoin or Ethereum for them, and they think that means they're in crypto, right? And it means you're barely in crypto. It means you have exposure to crypto, but that's kind of like dipping your toe in the water. And I would argue that it's not even. I would argue that that's not even crypto. That's just kind of exposure to a non-correlated asset class. Then there's sort of the next layer, which is, okay, these things have liquid markets that trade. And, I've come from not me personally, but, a lot of folks with traditional finance backgrounds that have traded, something before. The reality is that on a, kind of a micro level, on a day-to-day basis, these assets do largely follow the same kind of trading patterns that commodities or currencies and stocks also trade. And so if you're somebody who understands technical analysis of charts, you can probably look at something like Bitcoin or Ethereum or some of the other large cap cryptocurrencies and trade them as if they were a commodity or a currency, based on the technical analysis, based on short-term market movements, and that's kind of like the next layer. But then there is really again the asset class at its most pure. And so that means starting to understand, okay, there are thousands of cryptocurrencies. Some of them might be wildly undervalued or overvalued, depending on how you look at some of them. And so you might want to have direct exposure to these things that might have tremendous upside. Or you might want to, again, once you understand how DeFi works, say, not only do I want exposure to any one of these potentially thousands of assets, but we might want to do interesting things that are DeFi native with them, like get leverage or take out options or some other derivative. And that's actually, that's kind of what we call all the way down the rabbit hole. So there's, kind of a bunch of, levels of how involved people are in crypto, from dipping their toe in the water to being all the way involved. And so, when, I have lots of, on the retail side, people or friends ask me, what should I buy? If I, for people who aren't savvy enough to put on, option strategies, and they just want, to buy these assets to be involved in the crypto markets, from my perspective, it's just buy Bitcoin, Ethereum, and call it a day, because everything else is fraught with risk, whether it's technical risk or market risk. And as we were just talking about, even on the large cap stuff, there's a lot of trap there, right? Like even amongst the top 10 cryptocurrencies, and I haven't looked recently, so maybe it's fewer than were there before, but there are at least a couple of cryptocurrencies in the top 10 which are absolute farces, right? They are not real in any way, shape, or form, except for the fact that the market thinks they're real, right? That there are enough people trading these assets back and forth.
You want to go drop any names that you would?
I will not currently, but some of them are fairly obvious. But that's certainly one of them. The point is that in the case of the people trading them back and forth, because they are liquid enough markets that they move on, the kind of traditional technical analysis that there are enough people trading them back and forth that they do move on traditional kind of metrics. That's very dangerous, right? Like, even though you think, right, like you're subject to the normal trading risks of, maybe the market doesn't move according to RSI levels or Fibonacci levels, that one day people might wake up and realize that Shiba Inu is not real, right? And it might go to zero. And so that's a risk that you're taking. But even amongst real assets that, like say layer one blockchains, which were kind of the hot sector over say the last 6 to 12 months, depending on the time frame. But even amongst layer one assets, I will say, Cardano as an example isn't tremendously real. There isn't real usage or adoption of that blockchain, but the market cap would have you believe otherwise. But even so, even the ones that do have usage, are being adopted, do have real developer communities, these things are not guaranteed to be successful. They are not guaranteed that they will not go to zero at some point. I look at blockchains, and layer one blockchains are kind of the best example of this in terms of understanding the risk. Layer one blockchains, I sort of look at like operating systems. So when on the desktop, there are the legacy results tell you that there was, Windows and Macintosh and then Linux for hobbyists. But, there were other, MS-DOS existed before that, and it didn't, power laws suggested that at the end of the day, there were only 2 and call it a half operating systems that could be successful in the market. And the mobile operating systems were similar in that at the end of the day, you either use iOS or Android on whatever phone's in your pocket, even though Microsoft or Windows Mobile, poured hundreds of millions of dollars into trying to make that competitive. And Palm OS was also a very well-reputed mobile operating system funded by some of the top venture capitalists on earth. Money was no object. They had hundreds of millions of dollars to spend on that. But at the end of the day, there was only enough adoption for 2 mobile operating systems to win. So how many blockchains will end up being adopted at the end of the day? There are 40 to 50 blockchains, layer one blockchains, that probably have market caps in excess of $200-300 million. The one, and I don't know in this case whether the correct answer is there'll be 2 blockchains or 4 blockchains or 10 blockchains. My guess is it's somewhere between 5 and 15. That's a big spread, but I do think it's somewhere in that category. So what happens to blockchains 15 through 45 that have market caps of 200-300 million? These things can go to zero, right? And so for the average retail person, that's not a game you want to play. There's high risk, high reward. But if you are not paying attention to this full time and do not understand really the underlying mechanisms, the underlying forces that drive success or failure of these blockchains, you're best off sticking to Bitcoin or Ethereum and letting other people play with the rest.
Would you guys, any additional insights on that?
You were asking, I think the question is like somebody new to the space, like what do you say to them? On my end, I think I'm kind of on the shallow end of the pool. My goal, like mandate, is always just to try to get people off of zero. We have 297 clients, and I come from a traditional finance background. And so me getting into the crypto space in 2014, I was a closet degen Bitcoiner, and I couldn't talk about it because I worked at a traditional brokerage firm, and I did it as just an intellectual curiosity. And then I kept dollar cost averaging over time. And 2017 happened, and I remember busting out my Trezor wallet, and I was like, I think I'm rich. And then it crashed, and then I wasn't rich anymore. And I just kept buying. And 2020, I had started the new firm, and everybody was asking me about how can we get into Bitcoin. And it was a really long, arduous road as a RIA trying to do it compliant. And I can tell you, anybody else that's an RIA, maybe in the audience, beware. It's not easy. And as soon as I updated my form ADV, within 48 hours, I got a call from the Texas State Securities Board and said, hey, Mr. Stanley, great job. Thank you for filling out your ADV. By the way, we'll be there on Friday to come audit you. And it was arduous, not fun, didn't enjoy it, don't recommend it. And at the time, there were only 6 of us here in Texas that were RIAs that had actually run the gauntlet and come out the other side. And so as angry as I was that I felt like I got singled out just for trying to be a good guy, I'm glad I did it, because I have to look at it and I think to myself, I'm 40 years old, and if I've got a traditional IRA, I can't effectively touch that money. Like maybe you've got an old 401k, and everybody kind of waffles back and forth when you're new to Bitcoin or new to crypto in general. They say, I want to get in the space, but I don't feel like I can buy a meaningful amount because I can only maybe put in $1,000 or $1,500, but they want to get a whole Bitcoin. But they've got an old 401k from 3 different jobs that sat there for 10 years that they haven't looked at, and it's not doing anything. There's nobody managing it, and it's super simple. We just create a crypto IRA for them, roll the funds into a crypto IRA, and you can buy as much crypto as you want, or a Roth. And I have to look at it, and my justification is, do I think that crypto will be higher when I'm 70 years old and I can finally touch this money? Yeah, I think it probably will be. So do I think that's a good investment? Yeah, I think it probably is. I mean, past performance is no guarantee for future results, but I think if somebody wants to invest in crypto and you want to get off zero, I think an IRA is a good way to do it. And also, because you can't touch it until you're of retirement age, it kind of takes a little bit of that, I want to go buy it here and I want to sell it here and we'll rebuy here. Just buy it. Do you think it's going to be a higher number by the time you're ready to retire? Probably. So may as well buy some now.
So it just takes a lot of the emotion out of the, the process.
We try to hit the crypto easy button and get everybody off zero.
I think that's something that you see, on the, we're talking about the funds. They're not emotional about it. They're making their decisions at the quarterly meetings. They're going through it methodically, not aping in, and there's a time for aping in if that's part of your strategy.
Yeah, absolutely.
It can be, it can pay well, but it's if you're, the more emotion that's involved with trading and investing, the less the performance is going to be. And you sell at the bottom, you buy at the high, you sell at the bottom, you buy at the high. You do that a few times, and now you're down 50%. While the guy that forgot that he had Bitcoin is up a few 100%.
Yeah,
so
absolutely.
Jack, do you have any thoughts on when you're selling and buying Bitcoin back and forth? You're doing the high frequency. Is there any way for retail to participate in that game?
To a degree, there are a lot of regulations wrapped around that, right? Because the SEC doesn't want you to manage a substantial amount of someone's net worth, right? So there's this thing called an accredited investor, of which you have to be to invest in a hedge fund, right? Typically, a minimum investment of $100,000 or something like that. We do that from time to time, right? But there are quantitative strategies that can be employed by people who are just disciplined in the way they trade, right? That is possible. It is definitely possible. And it's possible to beat the market that way too, as long as people stick to their strategies, right? I definitely don't recommend active management for someone who doesn't spend 24/7 doing it and have some sort of background in it. That's for sure. I would say what these guys are saying and say, buy and hold Bitcoin, Ethereum, right? If you believe that over time, it will appreciate, right? So when it comes to, active management, there really has to be a team behind it. There has to be risk controls in place. There has to be someone studying the investment strategy at all times. And typically this is not the work that one person can do, right? And so it gets very complicated. And this is why hedge funds exist, to manage this kind of capital. So on the retail side of things, buy and hold Bitcoin, Ethereum, dollar cost average, these are all great strategies that don't require too much effort and allow you to live your day-to-day life without having to worry about it. And then just don't worry about it and stick to the strategy, right?
Where do you think the interest in trading comes from?
Well,
you have somebody that has $25,000 portfolio and they're interested in trading, and
Yeah, well, I mean, one of it is definitely potential profit, right? Over time, beating the market quicker than you would if you were to just buy and hold. I think that's a fallacy of sorts. I don't think that should be, the way of thinking about it. Another way to think about it is like, this is a puzzle that you want to solve, and that's kind of the way we think about it, right? And if you can solve this mathematical puzzle, then you have something that you understand and that you have a certain behavior within what you've created. And what you've created is basically another asset, right? Because you've created something that buys and sells other assets and has a strict behavior over time and does not deviate from that. So the interest from trading, it comes from the outsized returns and stuff, but at the end of the day, if you're not interested in the problem that you're solving, it definitely doesn't make sense to do it.
I want to just concur completely. I think I'm fascinated why people think that trading crypto is what you're supposed to do with it. And I think a lot of that came from the 2017 ICO bubble, where people just started issuing these tokens. And what do you do with these tokens, right? These are just Chuck E. Cheese tokens, right? And I'm going to trade them back and forth. I'm going to trade this one for that one. I'm going to trade this one around until I, increase my stack. When that view, the 2017 view of the crypto world was there were all these tokens, and then there was the centralized exchange, which was Binance and Coinbase and all these other, and that's what you did with them. You had them on an exchange and you traded them, right? But that's not at all what crypto is for, and what tokens are for. And so it is true that for the average person, a buy and hold strategy or dollar cost averaging or something very simple is always the correct answer, because you absolutely cannot beat the professionals. You actually, in fact, most of the professionals, especially if you're on if you're using decentralized exchanges, the professional traders are actually losing to the miners, and to the people extracting miner extracted value, which is a very deep rabbit hole that's not worth going into now.
Michael and I just had a 30-minute discussion about this.
It's right. So if the idea that you are trading the crypto is something to be traded, I think is just a fallacy in and of itself. It's not what tokens were meant to do. Tokens are, a way to make money and value programmable. And it's just that up until, call it 2020, when DeFi started figuring out, here's how you can use these programmatic stores of value in interesting new ways, that people didn't have anything to do with them but trade them back and forth. And so that's where I wish I could take credit for this, but calling those markets the shitcoin casino is what people thought tokens were for, to play in the shitcoin casino and speculate and trade them back and forth. But I don't think trading is a good idea for the average person.
And you look at the smaller coins that are there. I mean, Michael just showed where you can pull up and anybody can create a new coin. And, if I create a liquidity pool on a DEX and that liquidity pool is small enough, I can paint that tape and make those, make it look like this is, I can draw out a cup and handle on the chart. I can make I can make that happen just on my own until somebody gets interest and runs with it. And like you said, there's no value for that coin in the back on the back end. And it can get done. You can get dumped. You can get rugged. It looks great, and then all of a sudden the next day it's worth nothing. So it's it's a dangerous way to navigate. And even coins that do have value, I don't know how you guys, what your experience was, but when I first got involved with the business, I traded my way down from 20 BTC down to 4. So, I was up in USD and down in BTC and thought I was a genius, which was really, it's not there. You end up giving up most of the bull market. So does anybody have any questions? How late were we supposed to go, Ryan? Till 8 or?
However y'all want to go. Typically it's an hour, but if there's questions and y'all have energy, it just depends on the
What do
vibe
you-
of the group.
I think when we started, the idea for the panel was that we would start, typically when you have an event, at the end of the event, there's guys that this is what we do, for a living. We're sitting there, we'll talk around, we'll sit there and we'll have a conversation at the end of the event. and just different ideas pop up, and we'll go through it. So is there anything that you guys wanted to touch base on that we haven't touched base on regarding capital allocation, trading, that thinks would be of value? Was that a no? Nobody has anything. Listen, I know. I
mean, I love talking about it.
You talked about trading all day long and all the different things. I listened to this podcast, and you hear what people. I think it said that from a system standpoint, investors, most investors have no system whatsoever. It's just whatever is emotionally driving them. They look at the latest YouTube video or the latest
what their
tweet.
friend told them or something like that.
I'm sorry, what did you say, Jack?
What their friend told them or something like
Right,
that.
their friend told you. Your friend calls you up and says, "Hey, this is the time to buy. You need to buy right now." And then it drops 20%. You sell, and then it jumps, spikes back up.
I mean, we've all been there. I mean, if you traded anything, before getting into crypto, I mean, I've been down every trading rabbit hole over the last 17 years. And I mean, anybody who's been down that road has made all of those mistakes and then some. I know I certainly have. But, for me, just to reiterate the mantra, even though this is so far from, the typical interaction we have, at a corporate level, because we don't service retail clients. My first engagement with Bitcoin was I purposefully wanted to avoid making the mistakes I had made in the past about over trading and getting tied to positions. And the way that I did that was I set up an automatic debit from my checking account to buy Bitcoin every week. It was one of the only things I didn't turn off when the company I used to work for was sold and I was let go. It was like the only thing I have kept stable for years and years and years was this automatic debit of my checking account that I still have going right now.
You don't even notice it now. It's just built into your life.
That's the way that that was the way I chose to get involved. It was 2017. I was in the futures business. I like volatility and action. And I was like, what's this? This is a way for me to get involved. But this was one of the only successful, endeavors I have made, even being in this business for this long, having exposure to these markets for this long. It is really, really easy to get trapped in the idea of over trading and over leveraging and trading with money that you have not mentally disconnected from. You have no chance at making good decisions if you have not written off everything that you put into a speculative account. None. So, that just, again, this is a little bit far removed from what our business does, but I do want to reiterate again what these gentlemen are saying about, a good way or a solid way for someone to dip their toe in the water and continue to be able to participate without, taking risks that they can't afford to take.
I'll second that. I dollar cost average every single day, 365 days a year.
Yeah.
I have a debit out of my account, comes out every day. It's not a lot. Days that it's down a lot more, I buy more. But I don't sell it. I just keep accumulating. I don't know if it's not financial advice, but
No, but were we supposed to start
Yeah,
that way?
disclaimer.
With disclaimer. Yeah.
I have a question, if I can ask.
Yeah.
Y'all foresee a way, my background, I'm an insurance guy, so, do a lot of
indexed annuities or
index annuities and life insurance, so, do you ever see that happening here? I mean, it's all based on PE ratios and stocks, whatever, but do y'all see a way that somehow happens for crypto?
One thing I'll mention just is we, more related to the mining space, there are a lot of conversations right now about insurance in the mining community. I know of a few projects that exist right now about trying to how to develop these products. There's a huge regulatory issue. The other thing though is like, what about paying premium in Bitcoin? If you're insuring an asset, what about paying premium in that asset? But then, is the insurance company going to custody it? Because now we have a custody problem. And now they have exposure to the downside risk. So that they have to hedge it? I mean, you really can go down that path. It's a really interesting conversation. Right. Yeah, it's a fascinating, people are trying to figure it out.
I mean, they're just indexing with options on the traditional equity market, on a traditional index annuity. You could do the same exact thing probably through.
But it's not being done now.
It's not being done now, but I think, 2021, Mass Mutual bought Bitcoin for their balance sheet. They're one of the largest mutual insurance companies on the planet, and I think that probably, maybe that's your answer. I don't think somebody's toying with it in the background.
Oh, for sure.
Would be my.
And
Yeah.
I think that also they're trying to, unlike a much more mature market, you've got, these enormous companies have to trade in huge size. You have fragmentation problems. You have counterparty risk problems. I mean, if you buy downside protection, that only works if the market goes down, you can get paid. If the company you bought the puts from doesn't exist, it didn't do you any good. So there are, there's a lot of challenges there, but it's certainly something that's being, contemplated. And then some.
On the decentralized side, you can create your own indexes very easily. There are multiple protocols, Index Protocol, PiDAO, just to name a couple. I mean, there's a handful of them, but basically you can construct custom indexes very easily. Now, attracting liquidity to them is a different story. And then there's also, very solid, V1 attempts at decentralized insurance. Nexus Mutual, as an example, has, decent size for, and mostly they're insuring against smart contract kind of risks. But, they certainly would love to grow to insure all sorts of things.
Mike, Michael,
I don't,
did you have a
but
question?
I can go into why it's not worth it at given our risk mitigation to begin with. We don't need to insure those.
Michael, we're going to let Michael have that last question. Go ahead.
I was just going to ask, so you talked a lot about smart contract risks. Are there any risks that you're currently managing on either layer 2 or bridge assets? And if so, is that something that you can cover under some of the existing insurance options? And if not, is that a decision? If you're not currently invested in them, is that why? And if you are currently invested in them, how are you finding alternative ways to manage them?
So bridge risk is smart contract risk. It is, decentralized bridges use smart contracts in order to, effectively you lock an asset in a smart contract on one chain, and then it sends a message to another chain that says, unlock this amount of this asset to this address on another chain, and then uses kind of relays to confirm that, chain 1 and chain 2 are doing the same thing. So it's actually the same kind of risk. It's just a different application of it. Correct. And so bridges are without a question the riskiest aspect of DeFi. Vitalik in particular has talked about the world being multi-chain but not cross-chain because of that. And so, one of our largest positions in the hedge fund is currently multi-chain because they are a bridge that we use regularly. They're pretty secure. I mean, same thing from a Lindy test perspective. I think if they could have been hacked, they would have already. There's been there's been billions of dollars of assets in that bridge for quite a while now. So, the white hats have definitely been trying to get at it. Bridges absolutely have a ton of smart contract risk, but again, that's something we, anticipate is our job to manage. But I would assume that at some point, probably in the next year, there will be a catastrophic bridge hack that is going to cost billions. And that may change the way people use bridges going forward and think about using bridges going forward. But one of the more interesting things that we've seen in the market, if you think about kind of like the hype cycle around bridge technology and bridge assets, Thorchain was kind of the most hyped up model because they have a fascinating, not just security model, but economic incentive to provide liquidity to that security model. So both from a security perspective, but also the economic incentives to participate in that mechanism, and yet no one's using it. And what are people using? The centralized bridges. So the Binance bridge, the Avalanche bridge, the Polygon bridge. And people don't care that these things are centralized. And it makes sense because, if you're the Binance bridge and you're a CZ, right, you have no incentive to try and backdoor people's money. You have every incentive to make sure that people feel comfortable sending their assets over to the Binance chain in order to do that. So it makes sense. But at the same time, like nobody's seen that code, right? Like you can't be sure what's going on back there. And so the fact that people are using centralized bridges regularly and in huge volumes still shocking to me that they would prefer decentralized bridges to something like Thorchain. So I expect we have not seen the end of that story and something bad will happen.
Cool. I appreciate that. Excellent. We guys give the round of applause for guys for coming out and sharing what they know.